Yeah, good morning, everyone. It's 9 o'clock, and let us start. Uh, Today, I'm going to talk about financial math. About these sessions, I have planned 4 sessions, 1 hour each, and I have planned on every Saturday. That is today. Today is 18th, and then next session will take place on 25th March, 25th April, and then 2nd May, and the 9th May will be the last session. The last 10 to 15 minutes I have set aside for question and answers. I would request you to send your questions through the chat box so that I can actually get it, and then I can try and answer some of them. If the interest in the subject remains, we could plan further sessions. I'd like to speak a little bit about myself. As the name suggests, my name is Dr. Mahendra Mehta. I had been working in avionics or in aviation industry for about 15 years at Hindustan Aeronautics Limited, where I was involved in the development of radars, ground radars, airborne radars, electronic countermeasures, and something to do with the space science, missile programs. I was towards the last part of my stay there. I was also associated with Dr. APJ Abdul Kalam on the development of Prithvi missile, where I was responsible for development of onboard computer for navigation, control, and guidance. It was an interesting journey after that, and then from there I joined Citibank. Citibank I joined as head of analytics in India, where I stayed for almost 14, 15 years. And it was interesting. I mean, my journey to Citibank was quite interesting, and interview also was quite interesting because, and why I'm putting this in context is also relevant to what I'm talking, the subject matter I'm talking. The the interesting part was that the finance itself was undergoing a change. Before that, I have a postgraduate, and a doctoral degree, all in electrical engineering. To emphasize, I don't have any degree in finance. I have actually learned finance in practice, which I've been doing for almost now over 25 years, 30 years. So this is the little bit background of my talk and of myself. So interestingly, when I was hired by Citibank, things were actually turning around in the world of finance. World of finance, as we know, actually went through enormous turmoil in last, not turmoil, development, you can say, and several theories came. A lot of things were happening in finance, and as a result, the subject called mathematical finance, financial mathematics, computational finance, financial theories, you know, algorithmic. A lot of things actually started to come. Most of these have come in last 30, 40 years, and some of them have come in last 10, 15 years. So we'll talk more, as I go along. But before I go further, I would like to say that finance, a lot of new things were happening. One of the things which I'd like to mention here is the volatility in the marketplace, in the entire financial market, was undergoing a big change. The world was going in big. I'm talking about 60s, 70s, then came 80s, and then 90s, and then the century got over. But then, computation, finance, communication, all these actually got integrated, and the world of finance started to change very rapidly. When I talk of volatility, I was actually talking about the volatility, which actually, if you go maybe 30, 40 years ago, which was trading at 1%, 0.5%, 2% per year, almost went 10 times. Now the average volatility is, and we're going to discuss the concept of volatility because I know a lot of students who joined from IITs, they don't have a lot of background in finance. So one of the reasons is that not going to talk mathematically today, but I just want to emphasize, I'm going to talk mathematics without putting any. Let's move further, and then we can actually look at some more things. So finance to all the participants, and then why mathematics is important in finance, and what topics of mathematics are deployed in finance. I'm going to describe a little bit. And then one of the topic is of course the statistical science, which is also apparently used heavily in finance. We're going to discuss some examples where we can see how mathematics and statistics is deployed in finance. One of the things we are going to talk about is derivative maths in subsequent sections, and financial derivatives, the mathematics associated derivatives, and and then we are also talking about financial risks and how mathematics is applied in quantifying risk. Risk, I think, has become a huge dimension, and as I mentioned earlier, because the volatility was much lesser in many decades ago, the risk management, risk measurement, risk identification never became an issue. As the volatility actually started to go up, volatility means broadly, for those of who have less finance background, volatility is nothing but the variations in the prices or the economic variables actually. So there was a huge variation which started coming, and that is actually volatility is nothing but standard deviation uh, of the variables actually look at. So it's just statistically standard deviation. Financial analysts, they call it volatility. So it's nothing but standard deviation actually. I'm going to talk about this, more of this as we go along. And then on the risk side, we had a market risk, credit risk, liquidity, and other forms of risk. I think we'll discuss in detail about some of this risk as we go along. What is my objective of this course actually is the finance is, or the mathematical finance is very conceptual, and I don't think that it is difficult to apply. It also provides a very good understanding of financial phenomena, if you would like to call it. Because one of the objective of application of mathematics in any subject is to make the subject easier and not difficult actually. So that is where I think the mathematics really helps to understand, to penetrate into the functions or into the nitty-gritty of finance and try and brings it further to make it easier to understand what actually is happening. To encourage the need for learning mathematical finance, I also would like to encourage a lot of lot of participants who are listening. They have not learned mathematics in their school career as much as they should have actually. They are not focused so much, but I don't think it is late to learn mathematics, and it's very basic, and I actually don't think that it is very difficult to learn actually. So one of my objectives also to remove fear from many people about learning maths. The other phenomena which is taking place is artificial intelligence and machine learning is being deployed in finance. And this is expanding, exploding, not only expanding, exploding. And as a result, and these are all, this nothing but artificial intelligence and machine learning is nothing but statistics, extension of statistics, culmination of statistics and mathematics, and they are being deployed increasingly in study of finance and several other things. And as a result, it actually it makes the finance more interesting than less interesting. In some of the areas of finance, mathematics is embedded. You cannot do that aspect of finance without getting into mathematics. For example, financial derivatives, financial risks, portfolio management, algorithmic trading, and many areas. Increasingly, I feel that more and more finance is getting, mathematics is getting entrenched into finance, and it will become an integral part of the all financial studies. I actually wanted to give some quotes here. Einstein, he mentioned, do not worry about your difficulties in mathematics. Mine, let me just, I can't read here. Okay, I can assure you mine are far greater. I mean, Einstein was supposed to be one of the biggest mathematicians actually, and he did quite a lot of work. He was one of the scientists of enormous fame. The second quotation, which I'm quoting from Shakuntala Devi, I think quite a lot of you might know Shakuntala Devi. She was a number magician. Without mathematics, I had a chance to. Okay, without mathematics, there is nothing you can do. Everything around you is mathematics. Everything around you is numbers. Then Paul Holmes, the only way to learn mathematics is to do mathematics. It is clear that chief end of mathematical study must be to make students think. Mathematics is something which actually make the students think. It's logical and it helps people to think. And that's where the mathematics really is. The essence of mathematics is not to make things complicated, as I mentioned earlier, but to make complicated things simple. This is the beauty, actually. Very, very nicely said. And then Einstein further adds, as far as laws of mathematics refer to reality, they are not certain. As far as they are certain, they do not refer to reality. This is the limitation of mathematics. I think every science has limitations, and mathematics has also its limitation. So here we are limiting mathematics in certain ways. And here I also want to add, in applying mathematics to find answers of some of the financial problems, the above is very true. Because the finance is complicated, and it's not as simple as, one would think. When the finance gets complicated, we try to seek answers through mathematics. And to the extent that we can actually do it, we have to make enormous amount of assumptions. And when those assumptions are violated by the marketplace, then we find that the finance starts, or mathematics starts to break down. So when we apply finance or mathematics to finance, we also need to understand, where does mathematics really break down in reality. And there are cases where it has happened, and it's something we need to really understand. Coming to the next one, mathematics is, in my opinion, is the most elegant subject without any controversies. It's the only subject which has a perfect science. Why I say this is just to give you an example. Once a mathematical theorem is proved, it remains proven forever. Look at Pythagoras theorem. Pythagoras proved that theorem, that in a right angle triangle, the hypotenuse square is equal to base plus perpendicular square, whether it is in China or in India or in US. Once this theorem is proved, it remains proven forever. Nobody can question it because it has been proved mathematically. So in that sense, mathematics is a very elegant science, and it's the only science which actually is really true. The other thing which I want to mention is mathematics and computing go hand in hand. Learning a computer language is very desirable and necessary, if actually for the students who would like to practice financial mathematics, because I think that is the way the mathematics can be deployed in finding an answer for financial problems. Excellent programming tools are available for free. We have R, we have Python, and C++, C, Java, Scala. A lot of languages are there, but primarily I would actually suggest R and Python. Python is slowly taking over R, but R also is an extremely rich language. And the beauty of using some of these languages, these tools help you to solve many financial problems. And in the next week and a week after that, I'm going to is less than the weighted average of the volatilities of individual assets. So let's say that if you have 6 assets in a portfolio, and then each asset has a volatility of whatever, actually sigma 1, sigma 2 to sigma 6, then the volatility of the portfolio will be always much less than the individual sum of this portfolio, actually. And that, I think, was a major breakthrough in applying mathematics to finance. And this is where I think he used optimization technique to sort of come at this particular result. Then came capital asset pricing model, but by William Sharpe in 1970. This is the model which is theoretically examines appropriate required rate of returns of an asset to help make decisions about adding asset to a well-diversified portfolio. So the model, again, idea that the investor should gain higher yield when investing in high risk assets. So essentially what he is telling is that the investor actually is investing in a higher risky assets. He must be rewarded with a high return. And then he also, so hence the presence of market risk premium is a part of the model. So we'll discuss some of this as we go along, but then the concept of beta was introduced, systematic and unsystematic risk was introduced, and then he came up with the equation expected return is a risk-free rate. Risk-free rate, for those of you who are less familiar with the risk-free rate, is when you deploy a sum of money in the market where the probability of default is zero. That means there is no risk in the deployment and you will for sure get your money back with certain amount of interest. Plus beta into market risk premium. I think we will just see, I wanted to just put a small this thing, and then we're talking about systematic and non-systematic risk here. A broader concept of risk. This is the first time that he developed a concept of risk, in last century, a market risk that portfolio diversifies. Systematic risk is a type of risk which a portfolio diversification can't be fixed. Interest rate, recessions, COVID-19, wars are examples of systematic risk. As you have seen, on the onset of the COVID-19, the markets actually worldwide have fallen considerably. And now, of course, they are again coming back slowly because things are likely to get better as we go along. But that's the way the systematic risk really works. Unsystematic risk is specific risk, relates to a specific company or industry, strikes, mismanagement, all these, they are specific to companies. Something happens to a particular company because something has gone wrong to that particular company, and as a result, something has happened to the stock price, and that's how the unsystematic risk actually, and that risk can be diversified to a large extent actually. Then came arbitrage pricing theory. So one can look at the arbitrage pricing theory was that the theory of asset pricing that suggests the asset's price returns can be forecasted with linear relationship with an asset's expected return and economic factors that affect the asset's price. The APT or the APT asset pricing theory concept of arbitrage is different from classical meaning of term arbitrage. Let me try to define arbitrage. Arbitrage is a phenomena in the market which actually the financial players exploit. It's a process where there is a mispricing, and because of that mispricing, one can actually exploit the opportunity of buying something and selling something, and the risk is minimized sometimes to almost zero, and then a small return is made at very little or no risk, and that's the process of arbitrage. Here the arbitrage, in this particular case, arbitrage is not a risk-free operation, offers a high probability, but it offers a high probability of success. This offers traders a model for determining the theoretical fair market value of the asset. Then traders, they look at slight deviations from the market price and they trade accordingly. Some of these theories actually made a lot of assumptions, and those assumptions were violated by the marketplace. So this theory actually is still there, but I think it's helped in pricing a lot of products. Then came famous Black-Scholes equation, which actually was a major mathematical breakthrough in finance. And most of this actually deployed all whatever I'm talking about, they deployed heavily and banked heavily on mathematics and statistics. It provides estimation of options fair price, that is call and put, as we're going to talk a little bit more in subsequent discussions or next week or a following week. Option pricing theory uses the variables called stock price, exercise price, volatility. I think we're going to talk a little more on volatility today. Interest rate, time to expiry, to theoretically value an option. Now this was I think a major breakthrough where a deployment of stochastic calculus, Ito's lemma, partial differential equation, deployed to solve a financial problem, which is, I think, a very, very interesting breakthrough in finance. And with the introduction of option pricing, the finance actually made a huge, sort of leap in applying mathematics to finance. There are several assumptions in the model which are violated by the marketplace time and again. But with all this, the model is still robust and used heavily in the market today. Then we're talking about, let's just come to, so we just discussed on one aspect, we discussed what really took place in finance. So just to recap, what we saw was that the volatility went up, and in order to, in response to the volatility, people started to understand how the assets are actually behaving like this. And people in 60s, 70s, and 80s, they started coming with the theories of pricing various assets in various ways, and contingent claims or options or whatever, actually they're trying to sort of do that. On the other side, let's look at what is actually happening with the mathematics. Mathematics as a subject has been growing for centuries. I actually don't think the mathematics has been there almost from the time the human beings are there, as we can see at the modern civilization. But serious applications of mathematics in finance came in 20th century, over the period of this century. And the reason this happened was that quite a lot of answers, actually the financial analysts, financial sort of people started to seek answers through whatever tools were available, either mathematics or statistics or physics or economics, wherever actually, and they started seeking answers to get a better answer for their problems, which they actually found difficult to address otherwise. Then came the rapid growth in the computing and computer language, which also helped in deploying or applying, concept of science or mathematics into finance. The speed of computation also started to grow rapidly, as we saw. I think the computational speed, sharp reduction in computing prices, and now the cloud computing has made things much easier. Actually, rapid development in communication technology. All this is added to what actually we see is the modern finance. Tremendous increase in the market volatility. With all this, there was a huge, tremendous increase in the market volatility. So, if you ask me frankly, what is driving the market, mathematically, is the term volatility. Higher the volatility, more, access, or more people will seek, help from the mathematicians and see exactly how we can actually make use of this volatility for our good. Global integration, need for diversification and asset allocation, these are all part of the theme which actually came rapidly. And then mathematics in finance, we can say gut feel participants are finding it tough. Now, what actually is happening is that people were actually, in finance, we, or most people who are doing finance in 30, 40 years ago, actually they were operating using gut feeling, practice driven. Practice is changing rapidly as new players are coming in the marketplace. Theory driven, limitation of assumptions, and then comes the data driven. So now you can see clearly how the field has been changing rapidly. Data driven algorithmic trading in financial markets become I think about 40-50% of the trading which actually takes place in all markets, in equity market, in debt market, in commodity market, in derivatives market, and several markets is algorithmic, which is actually, now what is algorithm? Algorithm is nothing but a combination of computing and mathematics. Algorithm is nothing but set of rules which are actually deployed, and those rules can come from statistics or can come from machine learning, can come from AI, can come from statistics, and they are deployed there's a data driven process now. And with that subject came with the computational finance, which is now becoming increasingly popular. And the explosion in the AI and machine learning is also actually, taking the finance in that direction, where the conventional people who are actually practicing finance are slowly getting outdated in terms of whatever approach they have been following so far. Let's understand what's happening in the several financial areas, so that people actually can get a feel. I try to put something very simple here for the benefit of people who are actually less exposed to finance itself. I actually see a combination of people who are attending this this talk. Is there are people, students from several engineering colleges who actually have engineering, science, physics, mathematics, statistics background, and there are people who are practicing, and some of them are chartered accountants, some of them are consultants, MBAs, all that actually, and they presumably have some finance background, but less mathematics background sometimes. And there are people who have strong mathematical background, but low, no. So I actually, thought, let me just do a justice to, for people to really understand how, what actually happens in banking or in finance. Broadly, I've tried to define few slides where I'm talking about what happens in finance really, and what is finance. So I'm just describing banking here, and I've been associated with banking industry almost for now 30 years. And I can see, so I try to put all banking in terms of starting with I. We're talking about individual banking, institution banking, investment banking, insurance banking, information banking, and now of course you can do internet banking. All the entire banking can be done through internet, and that is where the marvel of technology and communication really helped us to reach almost anywhere, to do anything actually in banking or in, I think, looks like it. And I think rapidly it is growing. Now let me just try and describe banking here. And if you look at banking, finance is everywhere, and it is an important part of our everyday life actually. So broadly, finance is banking and non-banking financial companies which are actually doing finance. Now, what do they do? What happens in banking? For those of you who are less familiar with what happens in a bank, I think they know, I'm sure everybody is familiar with the bank. But generally, if you go behind the scene, bankers are doing, main task is lending and its management. That means the commencement of credit. And that is the most difficult thing a banks really do. And that's the, that means they have to do what is known as a how to give money, for how much time a money can be given, and how to evaluate if somebody is creditworthiness, and how much money can be given, and how do you exactly calculate if the default will take place or not. So now people are actually going towards what is known as the credit risk modeling. So that's where actually one of the application of mathematics is the modeling. That is corporate lending, retail lending, micro lending. All parts of lending is the main business for banking. The second thing they do is the liquidity management. Now, what is liquidity? Liquidity is a process where banks are supposed to give. What is the difference between banking and non-banking corporations? The main difference is the bankers, they take deposits. They can take public deposits. NBFCs cannot take public deposits. That's the main difference. Otherwise, most of the activities the bankers and NBFCs do are very similar actually. So when the banks take deposit, they also must provide liquidity to their depositors. And if the stress comes on the bank, then liquidity actually becomes a problem for the bank. And that is the second task which they do, is the liquidity management process. And for that, they do liquidity modeling, which again, it requires some amount of modeling, the liquidity, which is not an easy subject also from mathematical point of view, but I think a lot of things are actually happening and now they are using data science for liquidity modeling. Anyway, so risk management again is a third task, which they do risk computation using statistics, manage overall risk of the bank actually. So it's quite important that these are the three tasks. Now, again, I want to tell you that generally in the financial market or the banks, they do four things: lending, borrowing, buying, and selling. That's it. So you can actually, so if you look at this, everything happens around this framework. And in each of this framework, if you think you can deploy mathematics to make the process more efficient, that is where the value of mathematics really comes in banking. In personal finance, managing your own money, savings, investments, equity, bonds, real estate, banking, children's education planning, insurance, mortgage, overall budgeting, credit cards, retirement planning, taxes and estate planning. These are all individual banking affairs. Individual banking is a process where banks are serving individual needs. And some of these needs are actually, I try to put it here. So that's something people can see. And then I'm talking rapidly going towards the capital market. Now, in the capital market, what we actually do, the capital market actually can be divided into three parts, where equity, debt, and derivatives. So where is the mathematics coming really? So if you look at pricing and equity, you need some analytics or some amount of mathematics. Valuation. Once the pricing is done and the product or the instrument is out in the market, we need to value it. Value for the purpose of finding the gain or loss, finding the risk, and managing the asset or liability in a particular way. So the valuation is an important process. Then you would like to trade. So you need there also again mathematics is being deployed. Investment portfolios, again equity investment portfolio, how to select an asset, how to actually deploy an asset, how to diversify, look at the risk, look at diversification. All these actually are done through, very quite mathematical it has become. And the risk, of course, is again quite mathematics. Again, if you look at the debt side, pricing, valuation, again trading, investment, and the quality of debt, which is also now quite a lot of AI and machine learning is being used. And risk, of course, I think we'll see some of the risks. And derivative is full of maths. I don't think without math the derivatives can be done. Derivatives pricing, derivatives valuation, trading, market making. If you look, hedging is nothing but a process of risk reduction, a systematic management or mechanism where a risk can be reduced is what described as hedging. And of course, risk is nothing but risk and hedging, they go together in terms of what actually is happening. Then we are looking at the corporate finance. Corporate finance refers to, which is actually in my eye, this is look at institutional banking. So here corporate finance refers to financial activities related to running a corporation. So the let's say a company, actually a large corporation, it needs a lot of financial activities. It needs to raise capital through equity or through debt offering in the market. It needs money to expansion or to make sure that the products actually improve, for research and development, and a lot of other things actually. So then startup, they need capitals for the angel investors or venture capitalists. So they also actually do through corporate finance. IPO offering is also corporate finance field. Budgeting, balance sheet management. I think quite a lot of mathematics and optimization tools are actually being deployed in balance sheet management. I actually did this task in Citibank when I was there, spent considerable time in optimizing the balance sheet of the bank. So that means what you do is you use linear programming method to optimize the assets and liabilities allocation with certain constraints which actually are can be imposed, and then you arrive at the optimal sort of allocations of assets and liabilities with an objective function of maximizing the profit after tax. Then hedging the foreign exchange exposure, interest rate exposure, then commodity exposure, and a lot of other, whatever exposures you might have. Exposures means the risk of price going down or price going up. So this, for example, with this COVID-19, rupee has fallen. Rupee has fallen considerably. So people who are actually are importing things, they have to pay more rupee. So this is a mechanism. Some of the financial instruments, they provide mechanism to hedge some of your exposure actually. So that's where I think the options or a lot of other financial contracts come in the picture. Then we actually are looking at the financial markets. There are equity market, where equities are traded and equity derivatives are traded. The debt market, we're looking at interest rate dynamics. In the debt is nothing but a borrowing and lending in broad terms, which is also known as bonds, which actually are also known as fixed income instruments. So interest rate dynamics, yield curve dynamics determination actually. Now here, yield curve is nothing but a sort of a curve. On the x-axis is time and y-axis is the interest rate. And quite interesting actually. If you look at the yield curve of different currencies in the world, it gives you a very interesting picture what is likely to happen to the yield curve. And a lot of mathematics is being deployed, modeling, mathematical theory, AI, machine, all these are being deployed to forecast the interest rates. And that's something which is actually also a very huge application of mathematics in interest rates. Money market, which is a market where short-term borrowing and lending takes place. Commodity markets, again, where oil, gold, and other commodities are traded. Oil is a very big market. Gold, platinum, silver, iron, all that is traded very rapidly. And then you have a derivatives market. All these are financial markets, and these are all global markets. So it's not that it's local market. Derivatives have various forms are traded, and derivatives, of course, I think deploys modern maths in a hugely different way actually. So here we're talking about financial products which are traded in financial markets. So the products are equity, debt, bonds of various types. That is, we're talking about bond mathematics. Then you're talking about mortgage products, mortgage mathematics, then variety of derivatives, huge role of mathematics, forwards, futures, options, swaps, exotic derivatives. All these are actually, so what I want to say here is that everything in finance is mathematical in some way or the other. So mathematics has become an important part of practice in finance, particularly modern finance I'm talking about. I'm not Now let's see exactly what are the mathematical concepts which are deployed. Basic mathematics and some advanced mathematics, which actually are, here we are talking about mean value, mode, median, correlation, covariance, standard deviations, skewness, kurtosis, interquartile range, and some basic, covariance matrix, correlations, uh, and similar other things actually. So they are very simple statistics is being deployed. The second thing which actually I think people must know is the probability distributions. The distributions, normally normal distribution, log normal distributions, all the asset prices are said to be log normally distributed. Poisson distribution, binomial distribution, these are all distributions. And in next subsequent series, I'm going to discuss some of these distributions in more detail in terms of what actually, why distributions are required for understanding finance better. So something we will actually discuss. Then we require basic calculus. I think calculus is an integral part of anything. Whenever mathematics is deployed, calculus becomes an integral part. Mostly differential calculus and less of integral calculus, but some integral calculus is also deployed when we want to take concept from economics and bring it to finance. But otherwise, mostly we're going to use differential calculus. Ordinary and partial differential calculus and equations, they're also actually deployed when you go into contingent claims, like option pricing and all that actually. Stochastic calculus, Ito's calculus, mainly for financial options. This is a little bit complex, but one takes a little time to understand this. But I think the other four concepts are, I think, fairly straightforward, and mostly some of these concepts are taught at school level when actually these are all 11th, 12th class mathematics. Some amount of linear algebra is also required. Optimization is also actually important to understand. I think, linear optimization, non-linear optimizations, then there are several optimization techniques, and most to be a very happy situation, most of this optimization, if you understand it well, but otherwise one line of code in R or Python. So it's not very complex to understand. All you need to understand is what is the purpose of optimization, why you're optimizing, what you're optimizing, so that you can get the variables. And we will see run one or two cases as we go along. And then we also do Monte Carlo simulation actually. So these are some of the mathematical topics which are actually deployed mostly in understanding or in financial in finance. I would put it this way. One of the factor which actually we will see is the leverage. Leverage is an important theme in finance. I think for those of you who understand leverage or don't understand leverage, I think it was Galileo who said that give me a lever and I lift the earth. What he wants to say is that lever is something that using a small force, you can generate a much bigger, torque or thrust, so that you can actually do a much more work. We are talking about lever in gearings in the car or several other things actually. So similarly, the financial leverage is also actually an important part of the all the financial systems. The every corporations are leveraged. Derivatives are nothing but a leverage instrument. So leverage, the concept of leverage is need to be understood. So I think that is something which is very, I don't think it's very difficult concept really. Leverage, that the balance sheets are generally leveraged. Leverage in finance, it really means that you are actually deploying a much smaller capital and playing a much bigger financial game. 10%, 15%, 20%. As you know, the banks can leverage up to 10 times, 8 times. So their own capital, according to the regulatory requirement, was 8%. Now it has gone to 11, 12% with Basel III. But yeah, we are so talking about, if it is 10%, we are talking about 10 times leverage. So the regulation itself, it gives you possibility of leverage. And then of course, leverage comes, risk comes with the leverage. So that's something which actually need to understand. So leverage is one of the phenomena in the financial services or financial industry. Some other important terms, time value of money. I think it's the most important thing in concept in finance, where we deploy some very basic mathematics, where $100 received 1 year from now, what is the present value of that money actually? And that's the present value concept of future value, simple interest, compound interest. These are all very simple calculations. And then returns, daily, monthly, weekly, annual returns. Volatility is something which actually we need to talk about. So maybe next Monday or next Saturday, I'm going to take up this matter in a extensively in a different way, where I'm going to talk only of volatility, how volatility is deployed, and how volatility kills, or one can exploit volatility to its advantage. And we're talking about two volatilities, historical and implied. We're going to also spend some time on the term structure of interest rates and a little bit more details next time. And then stochastic differential equations we will see in the option pricing, and we will see modeling of a stock price movement. So here are some examples. So I'm going to calculate the volatility of time series maybe in the next time. Calculation of beta, I will show you something. Portfolio selection, modern portfolio theory is a good example. I will try and optimize a portfolio using a code which I will write in front of you. And you can see just 5 lines of code. We can optimize the portfolio. Then we are going to price an option, and you can see exactly how mathematics is actually deployed, exotic options, and financial risk calculations. Each of these calculations in subsequent lectures, I'm going to go in little more detail so that you can appreciate and understand to what extent mathematics is deployed to understand some of these things. And thank you very much once again. And with this, I close the session. Thank you.